Hi everybody, Dan Heelan here from Heelan Associates. Welcome to another video, this time a frequently asked question on director's loan accounts. Now the director's loan account is an area in the accounts where it states how much the company owes you, which is the goal, or in real bad times, how much you owe the company back. It's very possible to borrow money from your company, and actually in certain circumstances there can be very tax efficient and just an efficient way generally of borrowing money for short term. That needs very specific paperwork, but it's definitely doable. I think where people come unstuck is if they see their accountant once a year or they're doing DIY accounts and do this themselves, they can become unstuck because at the end of the year suddenly their balance on their director's loan account is the wrong way around and they owe money back. This generally occurs when you're taking too much money and not providing enough for your company tax bill, which at the time of recording is about 19%, hopefully down to 17% into the next year. So if you imagine there's two sides to your director's loan account, this left-hand side is when all your payments are coming out. So let's say you took £1,000 this week, £200 the next week, £50 the day after, all of it's getting added up here and gives you a total. What happens on the other side is that some of that will be marked off in salary, some will be marked off in a legally declared dividend, and there's another video on that. And then there might be some other things like you might be owed some expenses back. And the idea and the goal is that it either goes to zero at the bottom so no one owes anybody anything, or that this side is heavier and that the company owes you money. And when that's the case, there's quite a lot of tax planning tips that can be done. Now you can have it the other way around, and you can have this side heavier where you owe the company back money, and you can do that up to £10,000 for a short space of time without too much consequences. But you do at some point have to deal with that, what they call overdrawn loan balance. So depending whereabouts in the year that loan is overdrawn can cause you some problems. So if you're in that kind of situation, you definitely want to get some professional advice. But going back to the situation where this side is bigger and the company owes you money, that's quite good, because as we near a tax year end, you might decide that the dividends that you would normally draw, you're not going to declare a dividend, you're actually just going to draw some of your loan account. The reason you might do that is because your loan account's free. Now you can earn at the time of writing around 50 grand a year before you start paying higher personal tax rates. So a higher rate personal tax dividend is 32.5% currently. So the difference between 7.5% dividend and 32.5% dividend is rather large. And as a result, as you're nearing the end of the tax year, you might think, well, actually, I'm just going to take some of my loan account, I don't need the dividend. Now, you need to bear in mind other things, like if you're looking to get quite a hefty mortgage or something, you might want that dividend and pay the extra tax because you want your earnings on paper to be higher. So there's all these other things that go on, but generally, a director's loan account being in your favour is a really, really good thing. There can also be the opportunity where you don't necessarily want to pay the dividend physically out of the money, but you want to note and declare a dividend legally so that you can draw it at a later date. That can all be done with paperwork and is a really good, efficient way of doing it. Because especially if you're earning under 50 grand and you've got the profits to be able to have those dividends at 7.5%, you're going to want to use it while you've got the cheap money there at 7.5. Because the worst thing is next year you want to draw 20 grand for a new caravan or something like that, and you haven't used up your 7.5% in the previous year, and then you're going to end up paying 32.5% on some of it, which with a bit of tax planning would have been better. And that's where really good accountants come in, is to make sure you're using all these things, understand your goals and aspirations and just what your needs are from a finance point of view, really. So definitely have a chat with your accountant about this, or if they're not that kind of accountant, give my team a call and we'd love to have a chat.